Michael's question is related to that and maybe also related to what we show on power options in relation to the covered call picks of the day, the naked put picks of the day, and so forth. The comment is that your strategies are bullish oriented. Yes, radioactive trading, the married put structure by itself is bullish oriented. As have you never thought about bearish alternatives? The idea, of course, is that over many years the market has been growing over the past 2 years. We've seen that with some hiccups in between, maybe even 2.5. But Michael's thought to the reality is that the movement down is somewhat faster and easier than the movement up. Now, I agree with you on part one of that, but part two is a little bit different. I don't know if I agree with you, but I understand where you're coming from. I don't think it's easier to play the downside. Okay? He goes on to continue the mentality. For people, it's more acceptable to loss when the price is growing and they're short because it's probably a more gradual, slow movement. So if you're short stock and it's moving up, you see little losses here and there and you can buy it back and it's not that fall. And then when the price falls down and they're long, we all know that if we're long a stock or in a covered call, the drop usually isn't 0.5% or 0.3% we're worried about. It's when the stock falls 10%, 15% or 20% where we start to get worried. So you get a 20% loss here, and his argument is that unless you did a short position through earnings, you just see gradual increases. Okay? And it says, in general, more traders are bullish, and many of them close the position after realizing a small profit. So his concern is that if you're bullish, you're closing for small profits that are acceptable, but you still take that one-time hit that's a big loss. Almost like just trading credit spreads outright. We're getting 50 cents on a 4.5-point risk on a bull put or bear call. So you might make 8 trades in a row, and suddenly one of them goes against you because it's a bull put credit spread for the full loss, and there you are. You've just wiped out 8 previous trades. Okay? And then this is many times the reason why the stock's not able to go up significantly. So he's talking about the mentality of the market being bullish, but are there bearish ways? Now the answer to your question is that info is available. Okay? Related to the radioactive married put position in the 12 different income methods, investors who own the blueprint and the home study kit and are Fusion subscribers have access to a members-only webinar that talks about playing the bear side of the market with a limited risk techniques. There's different ways to adjust the position where that if the market's falling, we can still be in a limited risk structure, but taking profits to the downside instead of the upside. You could just reverse the concepts to a married call instead of a married put. We actually don't advocate that. Okay, we look at different ways to play the radioactive techniques in a bearish market. But of course, if I am in a bullish spread, which I'm in bullish spread. If I am in a married put where I'm expecting the stock to go up and I have the protection in place, and the stock does the opposite and move down, the benefit of those 12 different income methods that we teach in the blueprint is that I can use some of those income methods as the stock declines to profit to the downside, to generate income or potentially lower my cost basis as well. Now at Power Options, we do support both bullish and bearish strategies. You can search for bull puts and bear calls. You can search for buying calls or buying puts, and of course we have education for all those strategies as well. So yes, we have Consider It. No, we don't do a full write-up on it. We don't have a full separate booklet on bearish, but we do have webinars for blueprint owners that discuss playing it in a bearish market. In addition to that, I subtly disagree with one of your statements that it's easier to play the downside because of your comment where when that downside happens, when the hiccups occur, they occur fast and quick. So if you don't catch the full profit, you still might make a profit, but you usually have to get out within a 10 or 15-day period. Whereas on the long side, it is a more gradual gain, so I might not have to get out of it. Okay? All right, so those are my thoughts related to the bearish approach there as well. Okay? All right, so next. Is it possible in Power Options tools to analyze options on the Forex? No. We only support data for the U.S. stocks, indexes, and ETFs, not for the Forex or futures market. Okay? We do have tools to evaluate diagonal spreads, calendar spreads, which is kind of like what you're doing. You had a short-term option expire today at the 114 strike. You own a 114 strike on XDE. But we don't support tracking the data or analysis on the Forex. But if you found an ETF comparable to XDE, you may be able to simulate adjustments using our custom spread tool, but we do not support the data for the Forex. All right. And the fourth question from MB was technically, which was the third. You're currently a subscriber of the Optium Tradefolio. This is our service at PowerOptionsApplied.com, where we typically pick 1 to 2 credit spreads on the broad-based indexes such as SPX, maybe NDX as well. But since you currently subscribe to Optium, do you think there'll be any possibility for a blueprint discount? We never discount the price of the blueprints. We do have different promotions that run from time to time. If you're, many of you might not be, but of course, I'll send the link right now through the chat window, radioactivetrading.com/iridium, IRIDIUM. That's where you can see the current bonus offers for the blueprint. But I will say this, the subscription to Optium or the titanium portfolio at PowerOptionsApplied.com, which looks at covered calls, is a 30-day trial. So if you cancel the Optium Tradefolio within the first 30 days, you decide it's not for you, or you don't think it's giving you the benefit that you want, we can apply that first month to your purchase of the blueprint going forward. Okay, that's perfectly fine. We'll do that. But if you cancel in the first 30 days, you'll refund that anyway for the first month's payment of titanium or for Optium as well. But right now I don't have any joint promotions between being a subscriber of a Power Options or Power Options Applied service to another service or to the blueprint itself. All right. And going back here, Michael's final question was related more to the married puts as well, or the bullish positions at RadioActive Trading. What about using CFD instead of stock? Now, I had to have Michael explain this to me. I have never heard of this, and I've never used it in my personal account. CFD is the contract for difference, which I gather is mainly used in futures trading. And the idea behind it is that it's sort of a tradable contract like an option between a client and a broker, where you say, hey, if you pick up the stock from me at this price, I kind of want to get it at 34. The broker says, okay, I'll buy it for you right now at 34.90. You want it at 34, but if it goes up to 35, you owe me the difference, okay? Kind of thing. And the idea behind it, what he's looking to do is leverage, okay? And what he was thinking about is, wouldn't that be better to enter a married put, I'm assuming, based on his question, that you get into this without putting up much money. It's leverage, okay? So you're not actually buying the stock. You're, again, not even using an option. You're using a contract for difference to get into a security. At the same time, you're buying a put option there to cover the risk to the downside, or if you're shorting it, buying a call, vice versa. The one thing I noticed in the link that was provided about this idea is that the CFD is mostly used by day traders and is not suitable for buy and hold trading or long-term positions. Well, the married put and the married call are longer-term positions. My average time holding one of the radioactive trades is about 135 days, I believe, so a little bit over 4 months. And as the stock fluctuates up and down, I'm going to make adjustments following the rules in the blueprint. Now, in my personal account, this wouldn't work for me. I could maybe use a CFD if I found a broker who was willing to do this on a stock position. And I'd buy the put as I normally would for the initial radioactive setup. But eventually I'm going to want to sell calls against it, whether with one of the riskless spread trades that's talked about in the blueprint, 5 or 6, or just sell a call to create a collar. And in that case, I couldn't do it in either one of my accounts because it would count as a naked call. And I'm not allowed to do a naked call. In order to sell the call, I have to have the shares of stock, or I'd have to go out and buy a call to cover it as sort of a credit spread or as a calendar spread. And now I'm just complicating it with more legs. I now have a CFD out there to get stock. I have a long call that I'm using in my portfolio, which is subject to movements in the position in order to sell the call against shares of stock that I don't really own yet. And I have a put that's trying to protect all of it. So I don't know the exact benefits of this. What I mean, you pointed out the benefits, Michael. I agree with that. The advantage is lower monetary requirement, which sometimes can get us into trouble. The disadvantage is when exercised, the stock has to be bought anyway, and the CFD is sold out. Okay. But the concept is that the adjustments that I'd want to do, I couldn't do in my account if I was using this until I bought the stock. Okay. So for me, it wouldn't work. And to me, it actually complicates things in that fashion based on my explanation by having to buy a call to be able to do other income methods. Now I have to keep in mind where the CFD is, where my long call is, where my adjustments are, and where the long put is. How are they all gaining and moving together as the stock moves up and down? I personally just don't think it's worth it. I'm okay buying the stock and using capital. I do use leverage and spread positions with other portions of my portfolio as well. But in this situation, I don't think it's a good idea. We had customers a few years ago who were attempting to enter the married put using a synthetic stock position rather than buying it. So they'd buy a call and sell a put at the same strike to mimic stock ownership and then buy the put. I don't know the reasoning why, but of the 4 people that were attempting to use it over a 4-month period, 3 of them abandoned that idea within the first month and a half to 2 months and just started buying the stock outright as it's taught. The other investor, I think, kept continuing that going forward. I don't know what his outcomes were. I don't know exactly why the other 3 stopped doing it, but I think it just got into the idea of the lie of leverage and the risk of being assigned early and then having to cover it different ways, even though you have the insurance in place. So I've never done this. I don't know if I would advocate doing it because, as you can tell, I don't have the full knowledge of the CFD, and even if it's available for certain optionable stocks and ETFs. I'm assuming it might be, but the literature you sent me said is mostly used for Forex and futures, and it's not suitable for buy and hold trading, so I wouldn't consider this a possibility, personally, for getting into these positions. Okay? All right. So those are the rapid-fire 4 questions from Michael, and I know you have other questions coming in, but first I wanted to get to Marc K's question, which was also brought in via email. Mark wanted to know, can you review converting naked put positions that are assigned to collars, covered calls, or other strategies? Okay, so what are we talking about here? We're talking about a cash-secured naked put that we sold on a position, and then, of course, the stock fell below our put strike price. We wanted the stock to stay above the put strike price, so our put expired worthless. We kept the net credit. But then the stock falls. We didn't manage it, or it fell suddenly, and we were assigned early, and now we're stock owners. Okay? Well, there's multiple ways to convert this. And we're going to go ahead and take a look at PowerOptions right now, and we're going to navigate over there and use the custom spread tool as a brief example of how we would convert the position. And at the same time, this is going to also help lead into Joe's question regarding fixing a stock that has moved against him. There's multiple ways to do that as well. Let's see something here, folks. I apologize. Give me 1 second. All right. So I want to do this, and there we go. Okay, so what we're looking at here is the basic setup of the 14-day free trial to PowerOptions. I'm going to go to our custom spread tool right now, and we're going to talk about what would happen today if earlier this week when eBay went up above, let's say, to 37.40 or 37.50. I was confident in the stock. I thought it was going to stay above 37, so I sold today's 37 strike put and got a 40-cent net credit. Okay, so let's just go ahead and enter eBay. We'll select the July 21 series. I sold the 37 put earlier this week, and I'm going to say I sold it for 40 cents. All right, now, if the stock stays above $37 at today's expiration, the put would expire worthless. We'd keep the 40-cent net credit, and I'd have a 1.1% return, of course, for a 2-day trade. Not too bad. But the stock ended up down to 36.61. This isn't a terrible example at all. Okay? Sorry, I just saw another question coming in. I got an answer for that too. Sorry, just making sure I'm going through all the questions here as they're coming in. Okay. There we go. Sorry, Scott, the screen should have updated. I don't know why it paused again, but here we go. So here's my naked put position on eBay. Now the stock ended today at 36.61. Per the obligation of the 37 put, I am now going to have to buy shares of stock at 37. We keep our 40-cent net premium, so I have a 36.60 cost basis on the stock. And this is a fairly easy example, isn't it? Because what happens now? Come Monday, I'm out of the stock. I'm sorry, I'm out of the short put. We were assigned. My cost basis is $36.60 because I had to buy at 37, but I keep the 40 cents net credit. All right. So the key is, what can you do now? Well, we've got the stock at 36.60. Depending on my outlook, we could go 7 or 14 days out, and I could just sell a covered call. Let's just sell the 37 call for about 34 cents. Okay. All right. So now in 14 days, if I'm assigned at 37, if I think the stock's going to recover, I'd get a 2% return. Not bad, a little bit higher than I originally expected. We're in a covered call now, which is a parity trade. That's why we're looking at the very same risk-reward profile. Just converting it to a covered call once you're assigned stock. If you're concerned that the stock's going to continue to fall, we could use a lower strike price. But now you have to remember, what is your cost basis? Okay, so let's go back to August 4th, 14 days away. And I could sell the 36 for 88 cents. Let's call it 90 at midpoint, which isn't bad. Because remember, my cost basis was 36.60. So if I get 90 cents, we're still looking at a 30-cent profit. Even though we're selling an in-the-money 36 call, we're looking at a 30-cent profit, or about 0.8%. Not as much as we originally expected with the married put, but of course, we still have the higher upside. Now, this would give us protection if the stock continued to fall over the next 14 days. So it could fall down to roughly 35.70 before we're technically losing money on the position. It's a little bit of protection. That's why the return is lower. It's more conservative. But you'd have to decide based on what you think the stock's going to do next now that you're assigned on the position. If I'm going to create a standard collar, I have to keep in mind my cost basis. This is the key now. My new cost basis is the key. Just think it to yourself. Don't even worry about what you already collected of the put, because that's factored into your cost basis. But if you think, okay, I own stock at 36.60, that's trading right at that price, how would I structure a collar right now? Well, I'd probably go back and do the same thing. I'd sell that 37 call, and I'm likely going to buy a 35. Okay, so this will create a standard collar on our position. I'm not going to worry about midpoints here. We're going to add protection, so if the stock really keeps falling, we're locking in that we can't lose more than maybe 5 or 6%. We're still looking for some upside. So here we have a max risk of 3.8 if we're continued wrong, and 1.6%. Okay, and if you wanted to trade this longer term, well, then I'd go further out in time and probably look at the 37 put, or maybe the 38 strike put if it's available, following the radioactive trading techniques as well. Okay. Okay. And let's see here. Yeah, Scott and Walter, I see your two questions. I'll get to those in just a minute. They're related to each other as well. Okay, so I'll get to those in just a moment. Now, the real question, of course, here isn't this scenario. The real question is something more, let me think here, along the lines, let's say that I sold a put. I apologize, folks. Let me just think about this for a second. I don't want to use that stock. I'm trying to think of it. Go URI. Let's say that on URI, I was really bullish on the position, and we had sold today had earnings that were pretty positive. But let's say that I had sold a 125 put when the stock was above that a little while ago, and we had sold it for, let's say, 85 cents. Okay, well, now the stock's trading much lower. It's at 119.31. It didn't clear out the call. I'm sorry. Let's try that again, shall we? Fantastic. 125 put for 85 cents, all right? All right. So now the stock's trading at 119. We didn't do anything. We get put the stock at 125 today. Our cost basis is 124.15. Okay, so now, here we go. Let's clear that out. Add stock, 100. We had the 125 put, but we keep the 85 cents, so we have a new cost basis of 124.15. Stock's at 119.31. So we're down 5 points or so, 5%, 6% or more. Now, how could I manage this position? Well, I could convert it to a covered call, but I have to keep this in mind. My cost base is actually 124. So let's go out to standard August expiration. Can I sell the 120 call and make up the 5 points? No. Could I make up the 5 points selling the 115? Yeah. But now I'm agreeing to give it up at 115. The stock's trading at 119. What does that mean? That means that although this would reduce my cost basis down to 119, I'd get assigned at 115 and still have a 4-point loss. Okay? That won't work. Let's do it anyway. Let's go ahead and sell one contract of that, converting it to a covered call. We've lowered our cost basis to 117.95, but only to have the 115 call. That's not going to work. We're locking ourselves in a 2.5% loss. Better than the 5-point loss we have right now, but still not profitable. So we'd have to probably go with maybe the 120. We saw the 120 was only trading at $3. That's not going to get us back to square one because our cost basis is 124.15. Where am I going with this? So now this to me becomes a longer term management. I could go further out in time. We could go to September, maybe do the 120 right at $5 or $5.25 would be close to getting it back, but now we're longer term, 56 days out in time. So we might prefer to try to whittle this down, but remember, if I used a shorter term and sold the 125 call here for that lower premium of $1.40 or so, it's a 1.9% return, which is okay. It's not too bad at all, but I have to remember what my cost basis is. Okay, the 120 wouldn't do it, the 125 might, but remember the stock's still at 119. I haven't done anything to the downside. So now we might have to take some of this on the table to buy a further output. Okay, now this goes to Joe's question. Okay, so we're talking about stocks that have fallen in price. Okay, this one is a married put, and maybe it fell further than you wanted it to, so you actually have more than a 5 or 6% gain. Joe's issue was with Boeing. I don't want to call it an issue, but here we are. Okay, so we've got BA here, and buy 100 shares just for a simulation, okay? But Boeing dropped 5 or 6% yesterday. Okay, so he's looking at maybe a 5 or 6% decline since he got into the position. So should I try to sell covered calls on it to try to get back to the positive? Okay. Let me skip a beat for a second. Let me go actually look at Boeing. Let's see where we stand on our historical option chain. Okay, so I'm looking at the Boeing chain here. I'm going to go back in time. Okay, so it's 210 yesterday, 210, it's 208, 209. Okay, where's the, missing the big drop here, 208. Let me just look at the chart. Where's our drop here? Okay, you said Boeing BA. When you said it's down 5 or 6%, okay, I don't know when it did that because it's been moving up consistently. You know, if it's at a new high right now, I'm not sure. Okay, so this is, we'll take this a different rate. Okay, but let's say that, hold on here. Thank you. Sorry, Joe. No problem. That's what I thought. We meant HD. Okay, good. Good, good, good. So let's go ahead and get the chain for HD. Earnings surprise the other day. What I wanted to do there, HD. Fantastic. Let's get it. Get it right. My fault, not yours. Okay, so let's go back here. Where was my high price? 152. That was 155 for the drop. Two questions about that. There's more than that, actually. Okay, let's just make this fast, shall we? Let's take a look at that chart. When about was that drop? There it is. Just kind of missed it there. So it went from about 153 down to where it is right now at 146. Okay, so I missed it because I was too far away on the chain. No problem. All right, so let's use that price. Let me go back 1 second. Let's use that price about 154. We'll call it 154. Now, the stock's at 146 now. So we're looking at about a 9-point loss on a $150 stock. We're going to use 154, about an 8-point loss. Okay. Could you just sell calls against it? Now, let me go out a couple weeks. Let's go to standard August. So you're down about 8 points. The 150 is at 186. So if you think it's going to stay below there in the next 28 days, you could start knocking it down month by month by month. You could sell calls against it to try to lower your cost basis, Joe. That's one thing you could do. Okay. However, there are other ways to manage these positions. Whether you're assigned on the naked put and you're maybe 6, 7, 8% below the current stock price because there was a sudden drop. It's what we call the stock repair tool. So let's take a look at that. I'm going to go to HD up here. In the far right-hand corner, I'm going to click on the stock repair. We're going to use a cost basis of 154.50. And I'm just going to use 100 shares to keep it simple. Okay, let's see if we've got anything. We don't have anything in the near months. Okay, we don't see a repair built in August or the first part of September. However, there is a September repair, which is fairly interesting. Remember, our cost basis is 154.50. I want to write it real big over here, 154.50. What this tool does is it tries to build a ratio call spread by buying one lower strike call and selling two higher strike calls at a credit in order to lower the break even. So why is all this showing as NA here? What the system did is it tried to build repairs using the proper strike prices, found opportunities for net credit, but it didn't get you back to break even. Well, there's one in September we're looking at here where I could potentially buy the 145s and sell the 150s for a small credit of 11 cents and have a break even of only 149.70. Okay, how does that work? Let's click on repair details here. And the structure of the trade is right now we know we're at 146.65. We've got about a 785 loss on our position from 154.50. I could pay $5.15 to buy a September 145 call and sell two 150s at 263 to take in 526. Now this is only an 11-cent net credit, which I agree with. One contract and two contracts, $11 total. It's probably going to get eaten up by commissions. But why is the break even 149.70? Well, because think about what we did. We bought a 145 call and sold two 150s. We got a credit of 11 cents. Okay, but your cost basis is 154.50. So essentially what you've done is you have a covered call at a 150 strike at 11 cents plus a 5-point Bull Call Debit spread that you received at a net credit. So if the stock goes up to 149.70, what happens? This expires worthless. You still have the stock that's trading at 149.70. Your other short call expires worthless, but the 145 call that you were paid to own is now worth $4.70. So we have a profit and loss now of $4.80. 154.50 from 149.70 where the stock is trading is a loss of $4.80. But your long call is worth $4.70. You have an 11-cent net credit, so you are right at break even without needing the stock to go back to 154.50. That's the structure. Easier view is let's look at it graphically. So let's go to Analyze Trade. This takes us back to our profit and loss chart. Here's our structure. You have 100 shares at 154.50. We bought one September standard expiration 145 call at 5.15. Sold two 150 calls for 263 for small net credit. Now this doesn't give you a lot to the upside, I'll agree with that. But notice that you're at a profit at 150 now. If HD recovers and moves up to 150, you have a gain of about $61 or 0.4%. Where if you did nothing, or even if you sold the September 150 call, let's take a look at what the September 150 call would be by itself. I always see that it'd be about 263. So you'd still be $2 loss if you just sold the September 150 call. The idea behind this is that it helps you get back to break even faster. It can compile a stock repair ratio call spread to help lower your break even. But naturally, you only do this if you think the stock is going to recover. Notice what's missing from this. There's nothing protecting the downside. So you say, well, can I buy a put to protect the downside? Well, yeah, but if you bought anything such as a 145 put, you're probably paying close to $3 or $4. So that's going to add to your cost basis again. It's going to put us up to maybe 157 or 158. So this repair wouldn't work in that scenario, okay? Because it's a different combination. You're changing the moneyness in the position. So your stock is dropped. What are your options? You can sell calls against it, but remember, you don't want to sell too low. Even though the stock's at 146, I don't want to go into the weeklies and sell maybe a 147 or a 148 because it has a $1 or $2 premium, because if the stock moves up above that, now I've got to pay a higher price to buy it back. I've got to pick my target almost as this is a new trade. Knowing what the stock has done and where it is, are you safe selling the 7 or 14 day out 147 call or the 148? Say no. Well, okay, let me go 1 week out and sell the 150. Well, now your premium's too low. So you've got to go to maybe the August or the September where you're getting $1.60 or $1.70, which is only cutting in slightly. It's cutting in an amount. But remember, the total loss is about $7.85. Okay, so selling a call usually is a longer term approach depending on what the stock does afterwards. In all sorts of repairs, we do want the stock to go back up in price. So that's just selling the calls against it. 2 is the stock repair. We just kind of reviewed that. If you have the funds and you really think the stock's going to come back up, you could get better results in the stock repair or better results by selling a call if you average down. You could buy another 100 shares at 146, so your average cost basis might be around 150.85 or something along those lines, maybe 151. Averaging down is risky because now you've got $30,000 invested into one position instead of $15,000. But it can help you identify better repairs by lowering the cost basis and averaging down as well. Okay. Okay, and in relation to this, Scott asked a question. What would you do if you thought the drop would be 139 at support? Okay, so we think Scott's going a little bit more projective, and he's saying, what would I do in this situation if I think that 139 is the support? I'd probably do something crazy. Honestly, what am I saying? I'm saying the stock's going to drop another 7 points, and I want to take advantage of it. Question first, Scott, is, and I know you don't know this, but what is your target date for that? Is it 30? Is it 60? Is it 90 days out? Okay. Well, what I would do in that case, let's say it's 30 days out. All right, I'm just going to be nice for examples. 30 days out, we think the floor is at 139, and we think HD is going to continue this trend. What allows me to take advantage of a stock declining? Well, it's buying a put. But I already own 100 shares of stock that I want to protect. So how about I go out to August? And 130, in order to make profitable at 139, I can't buy the 135 put. The 140 would only give me about $1 difference in profit. So I'm going to consider the 145s here. Midpoint, we're going to call it 250. I'm going to buy 2. I'm going to buy 2 at 250. Sorry, forgot what I mentioned there. Okay. Now this alone is going to give me, sorry, I meant to buy 2. This is going to give me now a synthetic straddle, but it does have a high risk if the stock stays right around 145. I need the stock to move. It doesn't look like the break even is where we thought it would be at 139. So this might be too much into this position. Might have to go shorter term, but again, I'm basing it off when I think the stock's going to hit there. Can I help pay for it? Maybe. So if I'm thinking it's still going to drop, that's going to be a terrible position. Okay, so I wouldn't do this. I'd sell one call as a covered call at the 145 strike if I think the stock's going to continue to fall, and buy 2 puts. creates sort of a bearish position that doesn't get me to break even at 139. Okay, so this wouldn't work. But that's something I might consider. I've taken a long stock position and essentially converted it into a long put. Okay, my risk is still 6.6%, but if the stock does the opposite, in which case I'd try to get rid of the puts and get rid of the call. Okay, but that's sort of the case there. This is a quick conversion to make a bearish position, but it doesn't quite pay for that. Might be able to do some elaborate spreads on it, or just sell a deep in the money call would probably work if that was the scenario. We could just go with the 140 call, which is risky, really risky here, because remember your cost base is still 154.80, but we think the stock's going to fall and it's going to hit support at 139. Well, didn't do much for us, did it? Now, still not where we want to see it. Okay, so those are just some of the ideas. Probably go with the 145 call, but it wouldn't be that great either. But yeah, here's the key. If I think the stock is going to fall more from where my cost basis was, is at 146 now, I'm probably looking to buy 2 puts for my 100 shares so I can get some profit. It hits that 140, 138, I'll sell both puts, reevaluate my position. But again, if you think it's going to move back up, the stock repair, selling calls against it can work. Creating a collar will work to protect the downside, but as we saw before, you might lock yourself into a collar that's losing on the upside. You've protected the downside more, but you're just generating small premium against it. Might not be the best answer you're looking for. So, Joe, back to square one. Here's what I want you to do. We talked a little bit about some of the ideas that are available, and I want to make sure I didn't see anything here. There we go. Okay. Okay, so first off, Joe, what I want to talk about here, and then I'll get your second question, then we'll move on. Go to our webinars page. This is a public page. Don't need to be logged in to access the page. I'm sending you the link now. It's powerop.com/webinars.asp. In the options concepts section, there's a full webinar on manage your broken position. So these are alternative methods for managing a stock that has fallen in price, a covered call position that's moved against you and the call expired, managing a sold put that's in the money now and the stock has been put to you. We talk about that stock repair. We talk about averaging down and looking at the stock repair. We talk about just selling calls against it and other ways to help you get back to break even faster. So this weekend when you have the time, go to powerop.com/webinars.asp, click on options concepts, check on manage your broken position. Okay. Joe asks another question. I have a question. I have a strike of 205 on BA and it shot up to 211. What can I do to keep it from getting called away? You probably want to roll the position soon. All right, let's take a look here. You're in the money on the call. I'm going to go to the quotes page first. I want to look up some basic information. Yeah, roll the call or just close it. I might close the call because you've got earnings coming up on 7/26. And if you're in a covered call at 205 and BA is currently trading at 212.14 now, although it's going to be expensive to buy it back, if it moves up, you might just get assigned early on the position. Okay? And if it doesn't, if it falls back down, yeah, you might be okay. If the earnings disappoint, you know, that's something else to consider. If it falls back down to 198 or so, you're going to be fine on your 205. But consider this. If earnings impress and it shoots up, you get nothing more other than where you are. If you don't want to be assigned on Boeing, you're going to have to close that call prior to the earnings in 7/26. Remember also, if you keep that call open that's slightly in the money, it looks like the next ex-dividend date here is August 9th. So on August 9th, if the stock, for whatever reason, let's say is still at around 212 and you're holding the 205 for August expiration, you're going to be assigned early, most likely, because whoever's holding the right to that call is probably going to want to buy the stock at that price, be on record to get the dividend, and then likely close out of the position. Okay, so that's to keep in mind. Early assignment doesn't always occur, but remember when your option goes in the money, know what's coming up. You've got earnings coming up in 5 days. All right, you're already concerned about being assigned, so you're going to have to close that call or adjust it prior to the earnings event if you don't want to risk being assigned. Sure, the stock could fall and your call could be okay. Do you want to take that chance if you don't want to be assigned? That's the real question. So I wouldn't be, with earnings coming up, I might not be too focused on rolling your call up to a higher strike, say the 215, just to give you some more room. If you're concerned about assignment, what I might do is just buy to close the call, and then maybe buy a cheap 205 or a 200 put, just in case the worst case scenario with the earnings. So if the stock does fall to 180 or 170, you've locked in some of that with the 200 strike put, but you didn't pay that much for it. Okay, and then remember, ex-dividend on 8.9, you'll get another $1.42 for Boeing. And but if you have the short call that's in the money on 8.8, you'll probably be assigned early on that position as well. Okay, so that's what we want to do to Boeing. And of course, if you do have questions about rolling out, remember, we can enter in the position at any time into the portfolio. I'm going to put in the covered call very quickly. So we're going to do Boeing, and I'm just going to assume a cost basis for you a few days back, or maybe a month back. I don't know what the actual price was. But let's just put in a cost of 201, let's call it 203, doesn't matter. And we're going to sell the August, you had the 205? Did you say 205 or 210? Maybe let's just look at weeklies. Maybe you are just in the weeklies. Yeah, there we go. 205, okay? And let's say I sold this at the time for $1.85, something along those lines. Reasonable return on the position, about a 1% return, but now we're in the money. All right, 1.9% return with those numbers, different. But here's what you can do in the portfolio. Have a position that's in the money. I want to roll it. I know it's going to cost me about $8.45 to buy it back. Got earnings coming up in 5 days. So I'm going to use the More Information button. I'm going to go to Position Actions and then Position Analysis. This gives me a breakdown in my current position. Currently at a gain of 1.2% if I liquidated right now. Max gain return expected is 1.9%. And down below it shows me potential rollout opportunities where it's taking into account the original premium we received and the buyback cost, the new premium you'd receive, and what our new percent return if assigned would be, and the new probability of being assigned. So this is doing the math for you, and I can simulate the position side by side. I see a rollout that I like based on the numbers. I'll go to Simulate Trade from the More Information menu, and now I have a side-by-side comparison of what the original covered call was to what my new covered call would look like, the new potential return and more. But remember, I still have earnings coming up in 5 days. I still have that as well. Okay, the ex-dividend date coming on in 8/9 as well. Okay, all right. Okay, so I'll say 90. Okay, so the same, Scott, I know we didn't walk over the exact numbers on HD, but you know, I would do the same process if I thought it was 90 days out instead of the 30 that I showed. Right, I'd go to the November series and analyze, are there any adjustments with maybe buying 2 puts to the 100 shares of stock that might give me that synthetic straddle, which is a reasonable risk in between the strike prices and generating premium in the midterm to kind of help pay for it as well. Okay. All right. Now, James has a question. Does PowerOptions find the best option strategy for a symbol? Well, kind of. We do, but it's based on what you consider is the best strategy. Okay. And Jim, you had another question. This follows up. Example, if I'm bullish, does it look at long calls versus bull call spreads and bull put spreads? Yeah, it does. The tool that you want to use is called the Search Summary tool. It's available, I believe, in the signature tools, but also right up here where we just saw the stock repair tool and these links in the upper right. So I'll put in my symbol. Doesn't matter what it is. Let's just say Apple, sake of argument, and click on Search Summary. What this tool allows me to do is see opportunities, examples on a stock based on my selected expiration for bullish, neutral, bearish strategies, or whatever strategies you want to compare. So let me clear all these out, and if I just select bullish using the button down below, I'll be able to see covered calls, bull call spreads, bull put spreads, long calls, calendar spreads, collars, naked puts, and more. But if you just wanted to see examples of bull puts and bull call and long call, just take out the calendars, the covered combination, uncheck naked put and covered call, uncheck collar and married put, and hit submit. Now, oh, sorry. Let's go to August 4th, shall we? Be a much better idea. Here we go. So here are some combinations for the bull put credit spread. Reasonable returns, reasonable range out of the money. It's at 150. You might look at others. And you can compare them to the bull call debit spreads that aren't using the same strikes. I'm going to fix that for you this week on Monday, and then long calls as well. But what's the problem? Well, the long calls show you the price, but it's not really showing you your expected return. Okay, it's not projecting. You know, if you have a long call, you probably have an idea. So an idea where the stock's going to be, which is why you buy a long call. You're not just bullish on Apple. Apple's at 150. You're saying, I think the stock might be trading at 160 or 165 in 15 to 20 days. You have a target. Okay, so two things. First thing, Jim, you can use this tool to compare the different strategies. I'm going to make a correction on this, or have the programmers correct that, the settings behind it, so these are more equal. But if I ever want to compare the benefits of a bull call debit versus a bull put credit, I'm using one of our other signature tools that you can access under the credit spread menu called the spread chain. In the spread chain tool, you can look at credit spreads. This is showing me combinations of bull puts and bear calls which match basic criteria using the midpoint prices. Spread width that you prefer, minimum net credit, range out of the money, probability, and minimum return. But for you, let's change it to August 4th. We're going to look at Apple once again. But what I want to do is click on the put credit and call debit parity. Okay, and I'm going to make my changes, Jim. I'm going to put the strike difference at 2 because we're looking at weeklies. Minimum net credit 50 cents would be nice, but I'm going to go 25. Range out of the money, let's just start off with 1%, but I'm going to put in at least a 75% probability on the position. Okay, so let's see what we've got. There are 4 combinations on the spread chain tool. Over here to the right, just where I'm highlighting and circling here, these are my bull put credit spreads. And we see probability of 77, 82, 86, and 90. And we see returns of 14.3%, 17.6, 24.2, and so forth. Okay? Now, would I ever do a debit spread over a credit spread? Yeah, that's what's shown over here on the left, is the same combinations, but using the call midpoint for the debit instead of for the credit. Well, let's say your goal is the 85% range or higher. So you're only seeing 2 spreads. And the first one does offer a 17.6% return. Okay, so I'm going to go 85% or higher. Probability above. I'm going to take the first one, which is the 144, 142. Whether I'm doing a bull put or a bull call, it's exactly the same probability, exactly the same outcome. If the stock stays above 144, we make maximum profit. Stock falls below 142, we have the maximum loss. Okay, where am I going? The net credit is 30 cents at midpoint, or 17.6% on the bull put credit spread, 86.8% probability. On the bull call, it looks like I have a net debit of 167, which means if the stock stays above 144, I get $2 back. So I'm making 33 cents or 19.8% with the same probability. In this case, if this was my goal and I thought it was going to stay above 144, I'm sticking with the debit spread. Higher return, same probability, same outcome. But if you went to the 90, you see that the bull put is at 14.3 and 13.6. Okay, so this case, I'm going with the credit spread. No guarantee you're going to get the midpoint on the in-the-money calls, but if you did, this would give you a higher bang for your buck. So I'd be tempted to go with that. So when you want to compare debit to credit spreads on the same stock, which have the same outcome and the same probability, which one's better? Whichever one's giving you the higher return. Spread chain tool will show you that under the parity view. But you also consider the long call. You're looking at positions here that good probability and a good 19-20% return. But let's say you feel Apple probably has earnings coming up sometime if they haven't already. but you think the stock's going to be trading at around 158 or 159 in the next 14 days. How would a long call stack up? Go to long call. You know the numbers here, 17.6, 19.8% return, and 86.8% probability in 14 days. Go to Long Option Finder, another one of our signature tools. What does this tool do? We put in our stock. We put in our expected price. I'm going to use 159. Investment amount. So I was willing to put in $1,500 into a spread width or $1,500 into buying calls. And the expected date, let's use the same date, that August 11th date, 14 days out. Was I looking at August 4th? I apologize. Well, let's use August 11th, okay? All right, so let's submit that. In that brief instant, this tool looked at every available call that's available on Apple for all expirations. Grab the current price, how many contracts you could buy with your investment that you put in this case $1,500, and it calculated which option would give you the best return if the stock hit your target price and your target date. And here we are with the August 18th standard expiration 155 call out of the money. Currently priced at 186, you could buy 8 contracts with your $1,500 investment. If Apple did move up to 159 on August 11th, well, that's about right, isn't it? You've got a 155 call, the stock's at 159, it's got $4 of intrinsic value, and you've still got another 7 days to expiration, so 457 is a reasonable price and a 144% return. So what's better? That bull put we saw, or the bull call with the 86.8% probability that offered a 19% return? We already talked how we'd go with the bull put, bull call, but if you think more of a projection is in place, you're more speculative, then you plug that in, and you see here that the 155 call might get you a 144% return. No guarantees. The guarantee is that we know that that call would at least be worth $4 if it hit 159 just for intrinsic value, and then maybe an extra 30 or 40 cents is not out of bounds for 7 days remaining, a time premium on that particular position. Okay, so that's the steps, Jim. The search summary will allow you to compare them, but you won't see the end return for the long call. If you have a projection, that's where you want to use the long option finder, and I think a better view to compare credit and debits is jumping into that spread chain tool either underneath one of the vertical spread positions or in the signature tools tab as well. Okay, all right. So that was for James. A few more questions here. Start off with Paul. There's a search feature available in naked puts, covered calls, single option strategies, and other strategies known as the percent implied volatility range. The percent implied volatility range is where an option's implied volatility is now compared to where it has been over the life of the option. And Paul's question is related to this. He says, which strategies would you search for an IV rank of 50 or more? Now, this is not the IV rank that you're talking about that Tom Sosnoff and his partner talk about on Tasty Trade. It's subtly different. This is showing you a range of where the implied volatility of the particular option is compared to where it has been over the life of the option. Okay, so you want to say an implied volatility rank of 50% or more. Let's think about that. Implied volatility is a measurement of fear. And implied volatilities, you might have a range over the time for an option. So let's say when the option was released, it had an implied volatility of 10. Earnings are coming up in 10 days, and it's right at about 80. Okay, so your range is 10 to 80. Or let's say right before earnings it was 80, earnings came out, and now it's back down to 50. Okay, so this is in the higher 50 percentile of its implied volatility range. Okay, so what's the idea behind it? The theory behind the IV rank, the theory behind the IV range is that when you're in the upper 50 percentile, the option is inflated. The hope, not always the reality, the hope is that it reverts back to the norm. So what happens if you're near the upper range at, let's say, 70 implied volatility of an option that's between 10% and 80%? It's inflated here because it's near the high, and you expect it to revert back to the norm. Well, that implies you want to be selling. Okay? Because even if the stock doesn't move, well, hopefully it does, but even if the stock stays at the same price and the IV crushes down to 0.2, your premium's going to be flat. You'll be able to buy it back more cheaply. And then the idea, of course, comes in that if the implied volatility is at around 0.12 or 0.13, it's at the lower end. Well, this is a good time to buy because it might go back up to that upper IV rank range or implied volatility range. And when it does, the premium will inflate even if the stock doesn't move. So we can do that. Where's the problem? Where is the inherent problem, not only with the IV rank or with the percent implied volatility range for making a trade, is that the structure of the trade doesn't match the idea of what's theoretically best for implied volatility. How do I mean that? Let's just take, I don't know one off the top of my head, but take any farmer's, well, let me find one. I'll go weekly picks of the day real quick. Micron's a good one, Twilio, Weibo. Micron is not that great. Let me try this. Ooh, wow, Micron's all over the place. There we go. I want AAIO. Okay, AAOI. Applied Optoelectronics. All right. Let's take a look at AAOI. Let's not do that. Let's take a look at AA. My apologies. I'm going to look at the chain for standard. Now let's go again 14 days out to August 4th. Applied volatilities are in the 100% range, highly inflated. Percent IV range is probably equal to that. Let's look at our 90 call with our stock at 89.95. Go to research. Call research shows me all the information for the option. See the current implied volatility. The IV range is high. It's 56.1%, but it's been a lot higher. The total implied volatility has been between 0.70 to 1.34. We're currently at 1.06 or 106%. Okay, so you'd say, well, this is a good idea for selling. Because if it goes back to the norm, back to 0.70, I'm selling into high implied volatility. Really? Is that a good idea? What else is coming up with this position? I don't know. It just recently gapped a lot. It's got earnings coming up on 8/3 right before expiration. So where am I going with this? You'd say, okay, well, that 90 call looked pretty good. It's got a high implied volatility range. It's got high implied volatility. Most people say you want to sell into high implied volatility and high implied volatility rank and high implied volatility range. So let's say I do something fun. Let's say I just do a 91 call and I do a 88 put even. All of them would still have a high implied. If one of the stocks in the cycle, one of the options, excuse me, is overvalued and has a high implied volatility, pretty much all of them do for that expiration. Okay, so let's sell them both because they're inflated. Get a nice fat premium of around $15, $12.50. Nice wide, probably bid-ask spread on the position, but the max profit of selling, the short strangle, is very risky. The margin requirement is huge because you're in a naked call and a naked put. You say, okay, well, let me take off that margin and do an iron condor. Well, now you're buying into extremely high implied volatility, right? Because all the options around it are going to have the same thing, okay? That's the case, okay? So what strategies are best to do with a high implied volatility range and a low implied volatility range? Well, or IV rank? It depends, okay? Because the theory behind it all is that when it's high, you want to be selling, but it's high for a reason, and anytime you're selling premium, you're entering into mostly a directional trade, even with a bull put or a bear call credit spread. But it's highly inflated because some event or something's coming up that could cause the stock to swing wildly, and that's not a position you want to be in. How do you take advantage in either direction if a stock has the potential to move down 15-20% or up 15-20%? Well, you're buying a straddle or strangle, not selling it. But you got to buy into the higher premium in order to see that. Okay? It's a trade-off. Now, just like I do for everyone else, let me show you this, Paul. Okay, let's do this. Let's go into the free webinars. This isn't answering your question directly, but in general, what investors look for, by the way, is that when, in theory, when there's low implied volatility, that's when you want to be buying, and when it's high implied volatility, that's when you want to be selling into the IV rank or the percent IV range. And at the same time, I know I watched a webinar on his that I really enjoyed. Tom Sosnoff over at Tasty Trade. He said that the covered call position, which is a neutral to bullish strategy, he said the only times they had a breakdown of it, and said the only time those work is when the volatility of the market itself is above a certain range. Selling covered calls when the market's been going steadily up as it is and the volatility is really low is a net loss, because you're not getting advantage of the stock moving up and you're not getting any real premium because things are lower. The volatility as a whole is lower. So that's when you might want to be buying into positions. But again, it all depends on your outlook. What's more important than high IV, low IV, high IV rank, low IV rank is that the trade that you're selecting matches your sentiment for the stock. I don't care what your Greeks and what your implied volatilities are. If you buy a call on a stock that has poor fundamentals and is in a bearish trend, you're going to lose money. It doesn't matter what magic IV ranks you use or anything like that. Okay? That's the catch. And in that sense, same thing before. Webinars page, under the options concepts, there's a webinar here on implied volatility, the double-edged sword. Yes, it's about 3 years old from 2014, but we walk through exactly this concept. Only sell high IV, only buy low IV. You can't trade without knowing implied volatility. The only strategy I trade where I even pay attention to implied volatility is calendar spreads, diagonal spreads. Anything else I trade, I don't really pay attention to IV. I will look at the percent implied volatility range of my married puts. I usually want the put that I'm buying to have a percent implied volatility range of less than 70%. But in general, I don't pay that much attention to it when I'm doing my straddles, strangles, common positions, because I'm more concerned about the actual sentiment of the underlying security and if the profit matches my trading plan, as opposed to trying to catch this extra benefit of an implied volatility crush if I sell into it and it collapses, or an implied volatility spike if I buy into it and it goes up later. This webinar will give you more redundant information in a longer format of why I consider implied volatility the double-edged sword based on what everyone out there is saying, which I don't think is correct. Okay, and I don't mean Tom Sosnoff. I think he says things correctly, but there's so many services out there that all I see is that, you know, you can't be successful without trading into implied volatility, and you want to be selling always into high implied volatility, never buy. I have people that are calling me up and saying, I saw this fantastic naked call trade on an $11 biotech where I sold the 12.50 call for $3 and I didn't think I could lose, and suddenly now the stock has gapped up 60%, is trading at $19. Yeah, you sold into the highest implied volatility you could find because you thought it was a good trade. It had a phase 2 or phase 3 drug trial coming up and it spiked 60%. On the opposite side, some other investor might have taken a naked put on that position, sold a 10-strike put for $3, thinking the stock could fall to 7 and they're still profiting, and they're right. But when the FDA approval fails, that stock drops 80% of its value to $1 per share. Okay, you hedged your loss by 3 points. You're still looking at a 90% loss in your position. You now bought stock at $7 that's trading at 1, and all the option premiums are gone because the event's over. Poof, done. Okay, so that's why I refer to it as a double-edged sword based on how a lot of people trade that as well. Okay, I don't mean to be rude here, but I'm just in the mood to say this because it just struck me. Guy had a follow-up question. I have 2 more questions that are here, but Guy had a follow-up question. For bull put credit spreads, what do you look for IV? I'm going to be colloquial here just because I'm feeling in the mood for it. Not a damn thing. I do not pay attention to IV when I'm opening bull put credit spreads. Okay, and you might say, oh, that's dangerous. You're missing out on good trades because you're not focusing on IV. Now let me show you what I do. I'll start off with my weekly bull put search. The weekly bull put search, that Ernie created, and Ernie and I are testing now and making just a little bit better, and we're going to have that open as a picks of the day selection for bull puts and maybe bear calls next week. Okay, but I'm going to pull up the default bull put screens. This is where I start. Okay, all right. Nothing in implied volatilities. Nothing in historical volatilities. I'm not paying attention to it. What I'm looking for is stocks that are in an uptrend, because this is a neutral to bullish strategy guy. I'm looking for stocks that are above the SMA 20 and have had crossed over their MACD signal, have positive MACD cross within the last 3 days, don't have earnings between now and expiration, and then still have a probability of, by the way, I'm going to change this to what you're probably going to see. My probability is going to be 75. I think my net credit is going to be 20. my strike difference is going to be greater than or equal to 2. No $1.50 or $1.50 spreads. Okay, I could push up the percent return, but that's what I'm looking for. Okay, let me go ahead and submit that. Okay, so stocks, good trend guy, matching the sentiment of the stock, sentiment of the trade. Had recently had a MACD crossover, have a 75% probability, and at the same time, let's see, avoiding earnings between now and expiration. For 14 days out, August 4th, I have 6 results, Adobe, Avago, Skyworks, Alibaba, Nvidia, Netflix. Okay, positions with a good 7-8% return at the highest probability to let's just say 18.5 with a also reasonable probability of 80. Okay, these are stocks that are neutral to bullish, have good trends. I'm still going to further research and analyze them, guy. I'm not just going to pick off this list, but I'm going to look at the stock, make sure it matches what I feel comfortable with the trend. I like the returns. I know that because I put that in. I like the probability. I know that because I put it in. But let me show you something here. I know these criteria work because I back tested them. I'm going to go into choose columns. And we're going to go ahead and add in short implied volatility, long implied volatility. I'm not going to worry about the implied volatility ratio. Yeah, I'm going to add those two in. Oh, I'm also going to add in the volatility for the stocks, what's known as the historical volatility for the stocks themselves. Those are going to be our last 3 columns. And this is shown in that other webinar. Well, this is more than I expected, but the volatility for the stocks are between 0.19 and 0.43. But the implied volatility of the options are between 0.2 and 0.36. By using proper criteria to limit ranges to stocks that don't have what we know as an expected earnings coming up, are quality stocks that have shown good growth, good performance, I'm actually filtering by implied volatility already without even filtering by it. Because would a biotech stock appear in this list? Probably not, because it doesn't match some of that other basic criteria I was looking for. Would Johnson & Johnson appear in this? Probably not, because it doesn't have the return. A Johnson & Johnson trade with an 80% probability, where their implied volatility is around 0.1, is probably only going to be a credit of 14 or 15 cents, or about 5%. It's not going to match my net credit requirement. It's not going to match my return requirement. So when you break it down, looking for, if you just put in, you've heard me say this guy on many webinars, if you put in the criteria that makes sense for the strategy and reasonable criteria for return, whether you know it or not, you're probably already filtering by delta, gamma, implied volatility range, and more. I don't have it here, but I bet you if I started looking at all of these options here, the percent implied volatility range is probably going to be around the 35 to 55% range. Nothing's going to be at 90%, nothing's going to be at 10% or 5%. They're going to be in a nice reasonable range, nice reasonable movement. Okay, so that's where my focus is on these types of strategies. It's not the Greeks. I see nothing wrong, by the way, if one of your requirements for finding bull put credit spreads or naked puts is that you only sell puts where the delta is less than, say, 0.2 or 0.3, which would equate to about a 70 or 80% probability higher. I don't mean that. I think that's a good thing to use if you're not focused on probability, to use the short option delta. That's a good thing to use. What I'm saying is that I don't think you're going to see any extra benefit long-term in your portfolio if I put in this structure for stocks that make sense for a bull put spread, range out of the money and probability that makes sense, and a reasonable return. If I narrow this down to only those options that had an implied volatility of greater than 0.5, looking for more premium, well, we already know what's going to happen, right? Nothing. It's still running, but yeah, there's nothing that matches that. Okay, so, and in reverse, there's nothing going to be less than a 10% implied volatility. So my focus on vertical spreads, covered calls, naked puts, somewhat on my diagonal spreads, although there is a little difference there, and other positions is more on the fundamentals for the stocks themselves and a reasonable return. as far as what would go for the spread. And what do I mean by reasonable? I had a conversation earlier this week during a coaching session. A gentleman just signed up for Power Options out of the blue, saw one of my videos on YouTube, and what he wanted to find was bull put credit spreads less than 5 days out in time, so just trading that week, with a 90% probability of success. And then he said, but what I usually go for is I'm looking for returns or a credit of about 75 cents on a 2-point spread. So he's asking me, can the system find 3-day out bull put credit spreads that have a 90% probability and a 40% return? The answer to that question is no, meaning that if they're out there, this tool would find them in an instant by just clicking 3 things: taking out the filters, putting in 7 days to expiration, let's do it, 0 to 7 days, 40% return, minimum net credit of, let's say, 25 cents, because he would do 25 cents on a 1-point spread, and a probability of 90. Okay? Nothing's there. Oh, I'm sorry, let me go to 9 days out in time to make sure we're capturing the 7 days out in time. Nothing's there. Why? Because they don't exist. That's what I mean by reasonable. If you're looking for a 90% probability, the percent return you should expect is somewhere between the range of maybe 8 to 12% max. If you're looking at greater than 80%, yeah, there's only 65 spreads there. There's some that are really high, but not that great. And watch this. Okay, I have 18 results here on spreads that offer at least a 12% return 9 days out in time for next week's expiration with a 90% probability. There's 65 trades. What do we know about bull put spreads? I don't want to trade anything that has earnings coming up between now and expiration. So, no stocks that have earnings coming up between now and next week have a 90% probability and offer at least a 12% return. That's what I mean by reasonable expectations as well. Okay? All right. Ray's quick question, I'm sorry, and then I'll get to Scott's because he's been so patient here. Ray's question is, can you do this to find iron condors? Absolutely. It's one of the available strategies. We support over 23 of the most commonly used option strategies. Let me just take out long strangle. I'll add in iron condor. And then just as we saw with the other tools, what we were just running with, Ray, on the bull put credit spread, what we saw with one of the other searches we pulled up, I go to iron condor and I go to search. We now have the same table, very similar table that you saw for entering in credit spreads. Here's potential iron condors, weekly iron condor screens. And we've got some of the basic filters put in for you to use as a stepping stone. But now you can adjust things as far as what do you want for the total net credit, range out of the money for the short put or the short call, the percent out of the money range, meaning, equidistant, let's say, between the stock price. So you're not biased bullish or bearish, where the call and the put are almost equal distant away from the current stock price. And then your probabilities, probability above the short put break even or the lower break even, probability below the upper break even, percent probability between, and then just you have the same stock filters that you can customize to. You can kind of maybe use the Bollinger Band range to look more for stocks that are in a channel as opposed to a bullish or bearish, which we're using some of the other strategies we talked about with the MACD settings we had and more. But you've got all the filters there to screen for iron condors, whether you want to do weeklies, whether you want to do monthlies, and what criteria you want. Iron condors definitely is one of the 23 strategies we support. Okay. All right. So Scott's doesn't want to test my brain here, but he wants to test my strategy. What I mean by that is, Scott had asked way earlier. He's been working with the married puts and the radioactive positions, but struggle with performance. Okay. He says, I find myself in nice trades. For example, GLW. Stock is up 26.5 and the stock's down 79.5. Okay, well, you can't get caught up in those numbers because they're leveraged. I know what you mean, but you can't get caught up with those numbers, okay? So the put expiration is January 2018. Might be too far out in time. I agree with you. You say that you keep pondering the leap puts are more of a detriment than helpful. And you realize the blueprint suggests 6 months. I can say yes, that I feel that going too far out in time. So what are we talking about? I'm sorry, let me review here for everyone that's not familiar with what we're talking about. The married put is a common structure of buying stock, and buying a put position to insure it. Now, many investors teach, many gurus, many brokerage houses teach that you want to buy the stock and buy a 1 month out of the money put for a low cost. Well, the problem with that is that what are you told to when you're selling covered calls or bull puts? You want to be selling shorter term to get a better annualized return. If you sell month by month or week by week, you get a higher annualized return than selling a covered call that's 6 months out or 1 year out in time. Same is true with buying. When I'm buying protection, I want to be buying further out in time. Although it's a higher cost up front, it's a lower cost per day. The option that's 6 months out in time is not 6 times the cost. So the reason why we like to target 6 or 7 months out in time, and that's based on what Kurt found was the most successful in his portfolio. It did show more movement, but of course, usually I want to have most of my adjustments or most of my risk canceled within the first 3 months or so before I get to that last time value decay in the last 3 months of the trade. And a lot of times it's hard to do. A lot of times it's not. But yes, going too far out in time, to 2 years out in time, there is a lag. But again, I don't want you to be frustrated too much by where you're seeing your stocks up 26.5% and your puts down 79 because it's leveraged, right? You might have paid $12 for the put. Well, sure, it's down 79%, but that's $7.50, $8 almost, okay? True, you've lost 79%, don't get me wrong, that's not good. But if you paid $50 for the stock and it's up 26%, well, it's up 17, right? So you're still up about $10 on the entire position. That's the trade-off, okay? Let me pause for a moment. Sorry, screen sharing there. Let me pause for a moment, folks. I'm going to go look at something really, really quick. Sorry, I got to go RadioActiveTrading.com. I was getting, sorry about that, getting a little hot here. All right, now I'm not showing this, but I just want to look at something real quick. I'm going to remember one of my own trades. I had it in my portfolio. I'm sorry, I should have just done that. That was ridiculous. Give me 1 second here. I want to look at the opening date on a certain position. It's not going to be the best one, but it's going to be close. You know what? I can do something better than that. I'm sorry, but we're just going to use this anyway. January 23rd, okay? Sorry about that. Let's go back to January 23rd. I can't. Okay, sorry. I'm not going to be able to do that. I'm going to do it this way. I'll look at AEIS. It's peaked there. All right, so we're going to go back 1, 2, 3. We're going to go back to about May 1st when the stock was at $70, okay? Now that's far back as I can go historically. Yeah, I'm going to try this. I'm going to try something interesting here. I'm going to go to married put. I'm going to go to back test. And we're going to go to search by symbol. I said May as far back as, oh, I can only go back to the 22nd. Okay. And I'm going to use all expirations, less results. Let me see if I can do this. I have to put something together for you here, Scott, and I'm going to do it. They're all the same. Blast. Okay. So what I was just going to try to show you is real quick, put in some positions into a portfolio from a trading date where we know that the stock is up significantly, and I was just going to show you what we'd expect as far as percentage declines or turn downs and gain or loss on the stock. What do I mean by that? Let's say we took a stock that has moved up 15 to 20% in the past month or 2 months from earnings, and let's say we opened that a month ago, and we opened one with a September put, one with an October, one with a January 2019, one with a January 2019, and see what we'd expect as far as gain or loss. Now we know which one would be the most profitable. Would be the September. Whichever put was the cheapest would be the most profitable. But it will give us an idea of what to expect versus that. And I'll look up GLW for you later on. You know, we're almost at 7 o'clock here, 6 o'clock Eastern time. I apologize. So, I want to get some more ideas on this, but I'm going to jot this down for you. I want to do comparison of put declines, different expirations, and examples. And I'm going to get that to you as that. But I would say that I know that it's frustrating to see what you're seeing right now. You still probably have an overall profit on the position. That's true. The fact that you're seeing a 79% one on the leap is kind of surprising to me. I didn't think it'd be that high. I would think it'd be 50%. You'd have a 26% gain in the stock and maybe a 50% loss there on the put. But yeah, I'm going to take a look at GLW as one of the examples there and some other ones. But yes, going too far out in time, there is some lag, and there's not a lot of trading activity unless you react quickly. That's the other hard part. You might be seeing wide bid-ask spreads, and that could also be another complication. I like that target. My target's about 8 months. That's my average put selection is around 210 to 240 days out in time, 7 to 8 months, where my sweet spot is, where I feel my sweet spot is. When I'll do leap options is if I'm trading something that I have good growth but slow growth expectation on and is a double conservative trade in my account. What do I mean by that, Scott? Using the married puts is already conservative to begin with. But if I use a low volatility option that's far out in time with the leap, I go 2 years out and I'm expecting maybe 10 to 15 to 20% growth in the first year, I may be talking about something like Johnson & Johnson after a pullback, or maybe McDonald's if it's fallen to the bottom. I mean, those are strong, stable companies over time. And of course, I'm not feeling that there's a market correction potentially coming up where even though the stock is strong, it could fall down in price. Okay, so that's what I sort of mean by that. Why would I go far out of time? It's usually with a safer security in that situation where the implied volatility range is lower. Maybe the stock has fallen. It looks like a good buy opportunity. One time recent I did that was actually a while ago, about 3 years ago, and it was on Johnson & Johnson. You've probably heard me say that before. I think I got in at 70 and had the 75 put, and over the course of about an 11-month period, almost a year period, the stock went up to 94 gradually. I was able to do adjustments and roll the put, so I was bulletproof 2 months, 3 months before expiration, September, before January expiration. And I just kept selling out of the money calls against it to keep lowering the premium and getting costs. If I ever got assigned, I would just let it go, but it never did. It stayed right below that, my out of the money put strike prices. So I just sort of let it go. Okay, but I'm going to look at that more in depth next week. Get you some examples, get you some comparisons is a better term, Scott, and I'll do that also. All right, well, that looks like the end of the questions. I'm not just saying that because it says the clock. I did have a question from Walter coming in, but I'm going to address that as well, probably in a blog at RadioActive Trading, and I'll email him personally because he had to leave, and I apologize for that. A lot of questions there. So that's about, so I think, I hate when I do that, but that's okay. Sorry about that. That's not what I wanted to do at all. Wow. Sorry about that. Okay. So anyway, I just wanted to remind everyone, of course, that next week, Tuesday, we're going to have a radioactive trading presentation. Patience is a virtue, meaning that sometimes it's not the best time to try to force an income method right away. Wednesday at 12 noon here at PowerOptions, we're going to talk about researching a new position. And then Friday at 4:30 p.m., we're going to have our open forum Q&A once more. Recorded today's presentation. We'll get it posted for you soon. We'll have that available probably later this weekend or on Monday. You'll receive an email when the webinar is posted. And for those of you that currently aren't a member of PowerOptions, you liked what you saw today on the tools, remember you can take a 14-day free trial at any time. Just go to PowerOp.com, put in your first name, last name, and email address. You have full access to the tools for 14 days. And then, of course, we have varying subscription levels after that 14 days. Our end-of-day service where the data is only updated end of day is only $40 per month. We do also offer a delayed data service. It's $60 per month. That's inclusive. It's no extra fee for data. That's just what the price is. And we also offer a real-time service and then access to the historical tools as well, long-term, where our historical data goes back to 2006. Okay. We want to see some other education. We already pointed out twice today the webinars that are available for you on various strategies and options concepts. At any time, you can go to powerop.com/webinars.asp. It's a free page. Also, you can check out our blog, blog.powerop.com, and of course the YouTube channel at any time. You just go to YouTube, look for Power Options. Most of our webinars are archived there in public also. Okay. Well, again, thank you for joining me today. Thank you for your great questions. Covered Michael's early on, and we also addressed Marc K's question via email. Had some great questions, of course, from Scott there, from Paul, and from everyone else. Thank you so much. Hope you all have a fantastic weekend. If you think of any questions later on, remember you can email me at any time to support@powerop.com. You can also reach us at support@radioactivetrading.com. It really doesn't matter which one you email it to. You're most likely going to get an answer from me. Remember, you can also call us during market hours at 302-992-7971. And, you get myself, Ernie, or one of the other staff members, and more than available to help you out. All right? And, of course, those of you that are trial members and subscribers, you can schedule one of those free coaching sessions also at any time. That'll essentially be a 40 to 45-minute phone conversation with myself or Ernie. We'll answer any questions that you have, show you how to use the tools on the site as well. All right, so take care, everyone. Have a fantastic weekend. We'll be back next Friday. We'll also be back next Wednesday and at other times during next week for other webinars. You'll receive emails about those and when this archive has been published.